Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, we share insights about three funds that have reopened. Mike Hodel examines the communications sector. Brian Bernard analyzes industrials. Christine Benz explains how bonds can still play a pivotal role in your portfolio. Tony Thomas shares surprises from the latest fund flows report. And tax and financial planning specialist Jeff Levine discusses how to improve our tax position. Let's get started. Our insights about three funds that have reopened.
Hi, I'm Susan Jabinski from Morningstar.com. There has been a small silver lining to the turbulence we've been experiencing in the stock market. Several really good funds that were once closed have since reopened. Today, we're looking at three such funds that are now accepting new money.
Artisan International Value recently reopened to investors for the first time since 2011. And the recent market volatility certainly played a role in the fund reopening. Suddenly, the fund has more capacity than it had in the past. One thing that's been kind of disappointing, though, although this fund has a great long-term record, it didn't do very well or hasn't done very well in this recent market turmoil. It lagged the index by about 4 or so percentage points, peak to trough, but that's very unusual for this fund. Over its long history, going back to 2002, typically the fund has outperformed during market turmoil such as this. If you look historically, the fund has typically captured about 76% of the MSCI EAFE index's losses. So most of that outperformance over the long term has come from its relatively strong performance in down markets. So my point being, what happened in this recent market turmoil was more of an anomaly, historically speaking, than anything else. So for those looking for a fund, a value-oriented fund with a little bit of a quality bent as well, then Artisan International Value may be worth checking out, especially given that it just reopened for the first time in 9 years.
Fidelity Small Cap Discovery has had a tough year so far, but its strengths remain intact. When the Russell 2000 index fell 41% from its March 16 peak to March 18 trough, this fund fell nearly 47%, putting it in the bottom quartile of its small blend category. Manager Derek Jansen's approach focuses on strong businesses whose valuations reflect a margin of safety. The approach delivered consistent downside protection here and on his previous charge, Fidelity Small Cap Value, but not recently due to several factors. First, the portfolio that straddles the line between small value and small blend, whereas the index straddles small blend and small growth. This value tilt was a headwind as the Russell 2000 and Russell 2000 Growth both outperformed their value counterpart during the correction. The portfolio also suffered the 1-2 punch of large exposures to energy and businesses hit hard by coronavirus lockdowns. Heading into the correction, the energy weighting was nearly twice that of the index, and it was the leading detractor during the correction. Large positions in corona-sensitive businesses also took their toll. Nevertheless, the strategy has its merits. The solid approach looking for strong businesses remains intact and is evident in the greater number of holdings with economic moats versus most category peers in the index. As assets shrunk in the sell-off, the strategy, which has been closed to new investors since 2013, reopened on April 1st. It maintains its Morningstar analyst rating of silver.
Gold-rated Wasatch Small Cap Growth recently reopened to new investors after being closed since 2012. This is a strategy that we have a lot of confidence in. Lead manager J.B. Taylor has a proven track record at the firm. He's been there for nearly 2 decades. Given his experience and long track record, it's still not a star manager strategy. A big part of the appeal here is Wasatch's collaborative culture and team-managed approach. So Taylor works very closely with a team of co-managers and analysts on this strategy. They look for well-run, profitable firms that have exceptional earnings growth potential. Small cap growth can be a volatile market segment, but we think that the thoroughness and the consistency of their approach in vetting names as a team has helped smooth the ride over the long term here and also provide some meaningful protection in down markets. So overall, it's a really solid option and one of the best around for small cap growth exposure.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Now, Mike Hodel highlights which stocks performed well and which ones struggled in the communications sector.
The Morningstar Communications Services sector was reconstituted at the end of 2019 to reflect the blurring lines between several industries related to traditional telecom, the changing ways people communicate with one another and use networks for a multitude of daily activities. Previously, telecom stalwarts AT&T and Verizon dominated the index. Both firms still have large weightings in the new index, but not to the same extent. Combined, the two firms account for about 17% of the sector index. Instead, internet giant Alphabet is now the largest firm in the sector, with 28% weighting, followed by Facebook at 16%. The broader character of the sector has caused it to lose some of the defensive nature it has been historically known for. Sector performance thus far in 2020, throughout the turbulence tied to the coronavirus pandemic, has largely mirrored the broader market. The Morningstar U.S. Communications Services Index is down about 14% year-to-date versus nearly 16% for the broader market. Looking deeper, Alphabet and Facebook have posted declines similar to the overall market, which we think makes both stocks attractively priced. Alphabet is our favorite of the two. Advertising spending will certainly take a hit as firms tighten budgets in response to COVID-19. Alphabet's Google and YouTube platforms won't be immune, but we don't expect the firm's online dominance to wane over the longer term. The stock now looks more attractive than it has since the short-lived market downturn in late 2018. Disney's been among the hardest hit stocks in the sector, down about 30% year-to-date. And Disney has taken the biggest hit directly from the pandemic among traditional media firms because its theme parks business contributes about 30% of total revenue. Comcast, by contrast, the next largest theme park operator, only generates about 5% of its revenue from this segment. But the current pandemic also provides Disney with opportunities to extend its reach in new ways. With children at home from schools, Disney Plus has likely garnered increased attention relative to other streaming services, with moves like the early release of Frozen 2. We expect firms with strong content franchises and solid balance sheets like Disney will manage reasonably well through a downturn and will perform well, more importantly, over the long term. With the drop in Disney shares, we think the firm is attractive at current prices. Comcast's exposure to theme parks and media generally seem to have soured investors on the shares in this environment. The stock has underperformed standalone cable firms Charter and Altice USA thus far in 2020, which we believe is unwarranted. The core cable business still accounts for about 70% of Comcast's consolidated EBITDA. We believe this business is in great shape and should see minimal impact from the pandemic. An increase in telecommuting and television streaming, if anything, could further highlight Comcast's network advantage versus its phone rivals. In addition, Comcast's debt load, while a little bit higher than it has been in years past with the Sky acquisition, is still solid. Net debt is at about 3 times EBITDA versus 4.6 times for peer like Charter or 5.3 times for Altice USA. So we think Comcast is in a great position financially as well. The shares of AT&T and Verizon have diverged pretty sharply thus far in 2020. Verizon's provided the traditional stability investors have come to expect from telecom, while AT&T shares have declined about 20% year-to-date. Of course, AT&T's business looks a lot different than it did 5 years ago, and we've not been a big fan of the acquisitions that the company's made in recent years. But we think the market has unfairly punished the stock. The wireless business, which is still AT&T's largest segment, should have a solid year as fewer customers look to change carriers and as T-Mobile focuses its effort on integrating Sprint. While some investors seem to be disappointed that AT&T has halted share repurchases here during the pandemic, we're actually happy to see this shift. We'd like to see the firm continue to repay debt instead of buy back stock, lowering the risk of a dividend cut at some point in the future. We think the dividend is safe for now, but we'd like to see the firm return to a solid balance sheet like it's had in years past. Lastly, the strongest performers in the sector thus far in 2020 are, unsurprisingly, those that stand to benefit in a pandemic. Netflix sits at the top in terms of contributors to the sector thus far in 2020. We continue to believe that Netflix's limited distribution outlets, while a positive when everyone is staying home, will prove to be a disadvantage over the long term.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Brian Bernard on industrial stocks that are priced right.
The Morningstar U.S. Industrials Index underperformed the broader U.S. equity market by over 600 basis points during the first quarter due to investor concerns about how a COVID-19-driven economic slowdown would affect the sector. Many of the industrials we cover have shuttered manufacturing facilities and withdrawn 2020 guidance, which likely added to investors' angst. While many industrial firms will be adversely affected over the short run, we think many of these company stocks are priced as if the current economic environment is the new normal. In fact, most of our sector coverage currently trades in 4- or 5-star territory with a median price to fair value ratio of 0.8. Industrial conglomerates, construction, and aerospace and defense are the most undervalued industries. We see many attractive long-term opportunities across the sector that should bear fruit as the virus abates and business conditions normalize. Industrial conglomerates like General Electric and 3M have substantial healthcare exposure, which tends to be stable compared to more cyclical industrial counterparts. And stability is an attractive quality given current market volatility. Now, 3M and Honeywell, they also have sizable personal protection segments, which should see revenue growth as global demand for face masks and respirators exceeds supply. Farm equipment firms such as Deere may be more resilient during the COVID-19 outbreak because, in our view, it's hard to see how U.S. agricultural commodity production will be affected by the virus. U.S. acres planted remains relatively constant over time as demand for agricultural commodities varies less than discretionary goods. We think defense prime contractors are a smart play for investors right now because these firms are less exposed to the business cycle since sales are largely generated from the government, and governments across the world have been focused more on military modernization. Customers also fund research and development, so these firms can return free cash flow to shareholders. With second quarter earnings right around the corner, we'll be listening for insights on the 2020 outlook. However, given how much uncertainty there is right now, executives may shelve these types of discussions until the next quarter.
Now, Christine Benz explains how bonds can still play a pivotal role in your portfolio.
Hi, I'm Susan Jabinski from Morningstar.com. The COVID-19 crisis has driven down the yields of high-quality bonds, leaving many investors asking themselves, what role, if any, should bonds be playing in my portfolio today? Joining me to address that question is Christine Benz. Christine is our Director of Personal Finance at Morningstar. Christine, thanks for joining us today.
Susan, great to be here.
Now, the Fed has cut interest rates to near zero. So what are the implications for bond investors? What can they expect from a return perspective?
Well, it's not good, certainly over the next decade. One thing we know about bonds is that yields are pretty predictive of the return that you'll earn over the subsequent decade. So with very low single-digit yields today, that portends a very low returning asset class here. And then another thing that you can't help but think about is that even though no one's worried about any sort of imminent interest rate hikes, given the economic weakness that we're experiencing, rates at this point have much more room to move up than they could move down. And that could affect bond prices. So those are some headwinds for bonds for sure. I think investors are right to be questioning and thinking about their role in their portfolios.
Yet you still do think that bonds can and should play a role in some investor portfolios.
I do. So for younger investors, for people who have a very long time horizon for their funds, they really don't have a need for a big allocation to bonds unless they're extremely risk averse. But the closer you get to your goal date, especially retirement, the more you'd want to think about battening down the hatches with the portion of your portfolio that you expect to spend soon, because bonds really do still serve that role of shock absorber in investors' portfolios. A portfolio that was all equity, all U.S. equity, would be down about 19% for the year to date, whereas a balanced portfolio like a 60% stock, 40% bond portfolio would have been down just about 10% for that same period. So bonds do add ballast. They do help take the edge off in periods when equities are volatile. And I think you can realistically expect that there could be a fair amount of volatility in the days and weeks and even months ahead.
Now, your time horizon should play a significant role in the types of bonds that you own, right?
That's right. And, it was interesting because we did see bond prices bop around a little bit during the recent equity market volatility, especially some of the corporate bonds, municipal bonds as well. But I think investors can really help themselves by thinking about their time horizons, their proximity to spend down, and use that to inform what types of bonds to own. So if you have money that you need really soon, my advice would be to keep those funds in cash or maybe in very short-term, high-quality bonds. When we look back on the historical performance of high-quality short-term bonds, what we see is that they have very few one-year periods where they actually end up in the red, so very few 12-month stretches of time where they lose money. And when they do encounter those rough patches, they tend to be pretty shallow, so they can recoup those losses pretty quickly. So I would say if you have money where you're sort of a couple of years into the future in terms of spending from those assets, you'd want to think about high quality short-term bonds or bond funds. On the other hand, if you have a slightly longer time horizon, say a 3 to 5 to 7 year horizon, I think there you can think about a high quality intermediate term fund, whether a total bond market tracker, maybe some sort of an active fund. When we look at how such funds have performed in market history, they have had more periods, more 1 year periods where they've had losses, and those losses have been deeper, which suggests that you wouldn't want to use them for any very near term expenditures. But if your time horizon is slightly longer, you can afford to take a little bit more risk because you can, at least historically, pick up a little bit of a higher yield.
And while we're on the topic of bonds, let's pivot to a related subject, inflation. Why is inflation so important for bond investors to pay attention to?
Well, it's the natural enemy if you're a bond investor, because if you think about it, the income you earn from the bond coupon, that's your purchasing power. And when inflation is going up, that eats away at the purchasing power from that bond. So you want to be really mindful of inflation with respect to your bond holdings. Right now, there is not a lot of concern over inflation. We have a pretty tepid economy or worse. And so I don't think that there's a lot of concern that we're going to see prices take off from here. But over time, it could become a bigger factor. And remember, as a bond investor, if your yields are really low, inflation doesn't have to be that high to eat away at your purchasing power. Another concern that has been out there has been the role of some of the stimulus that has been going on to keep the economy moving along. Could that be inflationary down the line? So my bias is not to get too fancy about adding and subtracting inflation protection from your portfolio, but rather, again, use life stage to guide how much to be worried about it. If you are someone who has a paycheck coming in, so if you're still earning a salary, your paycheck typically is inflation adjusted in some fashion. On the other hand, if you're retired, I think there it makes sense to maintain an ongoing allocation to inflation protected bonds, either some sort of a treasury inflation protected bond fund, or maybe using I bonds, or maybe a combination of the two, using that as an ongoing hedge against unexpected shocks in terms of inflation. I think that that's a good way to think about maintaining inflation protection on an ongoing basis. That way you're ready for it when and if it materializes.
So it sounds like there are still plenty of reasons for us to consider bonds for our portfolios.
I think so.
Thank you so much for your time, Christine. We really appreciate it.
Thank you, Susan.
I'm Susan Jabinski from Morningstar.com. Thanks for tuning in.
Expand your investing horizons and look to the long view with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Next, Tony Thomas shares where investors pushed and pulled their money.
Hi, I'm Susan Jabinski with Morningstar.com. As we know, March was not a great month for the stock market, with the S&P 500 down more than 12%. And that's on the heels of a pretty poor February, too. How have investors responded? Here today with me to discuss March fund flows is Tony Thomas. Tony is a senior analyst in Morningstar's Manager Research Group. Tony, thanks for joining me today.
You're welcome, Susan.
Now, let's start with some broad numbers. It was not a pretty March for fund flows. Can you talk in broad terms about what we saw?
Right. It was a tough month for long-term funds. Investors pulled $326 billion from those long-term funds, and that's 3 times the amount of October 2008. Now, to give that a little bit of context, though, the damage was sort of equal across those 2 months. The March outflows were about 1.7% of the total net assets at the end of February. And back in 2008, just as we were in the global financial crisis, it was about 1.5% of total assets. So similarly damaging on that front, but again, 3 times the amount in dollar terms of what it was in October 2008.
And that's maybe disappointing, but not really that surprising. But there were some surprises when you dug into the numbers as you did. One of those actually that was surprising was how relatively well U.S. equity funds did in terms of fund flows, considering how terrible the U.S. stock market was in March.
Right. I mean, it is surprising. I think when I took a look at this data for the first time, I was shocked to see that there were actually some modest inflows of about 10.5 billion into U.S. equity funds in March. Now, a lot of that went to passive funds, like the SPDR S&P 500 ETF, which had record outflows the month before, but then saw record inflows in March. So passives took in 41 billion in March, but actives lost 31 billion. And that's been a long-term trend for those funds. The March outflows were actually roughly equivalent to the outflows that they had in January, even before the sell-off began. And they've been in outflows for about 90% of the months of the last 10 years. So, that story is just ongoing. And to be clear, it wasn't particularly bad, but it's just been bad for active equity funds for a long time.
Right. Passives sort of saving the day there in March for
Right.
that group. Yeah.
Right.
Now, another surprise would be sort of the magnitude of the outflows that we saw in March for bond funds.
Right. So both taxable and muni bond funds had record outflows for the month, and they were significant. I mean, very substantial. Now, to be fair, they've had a very long streak of good inflows, really going back to the financial crisis. But both taxables and munis had inflows for over a year. In taxable, they had 479 billion of inflows in the previous, I think, 14 months going into March. But then in March had 240 billion of outflows. So almost half of that going out the door in March. And similar damage in munis as well. So that was very surprising to see, and that affected a lot of fund families going forward.
Mm-hmm. Well, and that's another one of the sort of surprises that we discovered in the numbers for March was, how sort of fund families that maybe had been doing kind of well, really did experience some outflows.
They did. The bond fund outflows really hit firms like Fidelity and PIMCO. I mean, some of that might have been expected, but rather interestingly, it affected Vanguard as well. So, I mean, they're the behemoth asset manager out there, but they had 37 billion of outflows last month, and that's rare for them to have monthly outflows. That's only the fifth time since 2000 that the firm has had monthly outflows from its long-term funds. So, I mean, to be fair, that's only a drop in the bucket. I think they have $4.5 trillion of long-term assets, but nonetheless, I mean, that just shows the extent of the damage that was done last month.
Tony, thank you so much for joining us today and giving us a little bit of an update on what investors did in March. And we'll see what April brings.
Indeed. Thank you.
And for those of you who are interested in digging into Tony's report, it appears in its entirety on Morningstar.com. Thanks for joining us today. I'm Susan Jabinski. Take care.
And lastly, tax and financial planning specialist Jeff Levine tells us ways we can improve our tax position.
Hi, I'm Christine Benz from Morningstar. Amid the unfolding coronavirus and its related economic impact, some investors may find themselves in a temporarily low tax bracket. Joining me to share some ways to think about improving your tax position in such a time is Jeff Levine. He's the lead financial planning nerd for Kitces.com, the director of advanced planning at Buckingham Wealth Partners, and the lead creator and content expert for Savvy IRA Planning. Jeff, thank you so much for being here.
Thank you for having me.
Jeff, you've been very busy writing about the implications of the CARES Act for investors and advisors. Let's start with this general idea that it seems like a pretty safe bet where we are in 2020 that many people's tax bills will be lower this year than they were last year. Many people are experiencing job losses or related income reductions, and we have not gotten off to a great start in terms of investment gains either. So I want to talk about strategies to take advantage of people landing in lower tax brackets this year. Let's start by looking at conversions of traditional IRA accounts to Roth. Why might that be advantageous right now?
Sure. I think that now may be perhaps one of the best times we've seen in the last decade for a lot of people to make these conversions, if it's right in the first place. If if you happen to be one of the lucky few who continue to have an income that was commensurate to previous years, maybe now is not the right time. In other words, just because asset values are low doesn't mean you should overpay your taxes. But if a conversion was right in the first place, doing it while we're at depressed market levels can be a really great thing, because as the market rebounds, which historically it has always done, then you ride that rebound inside your Roth IRA where all those gains can be tax-free. So it's an ideal time to look at doing that. And for those investors who may be on the fence, who are looking at this and saying, I know we're low now, but I think we're going lower. If they kind of have that pessimistic outlook, maybe you hedge your bets a little bit. Maybe if you were planning on doing a $100,000 conversion, you decide to do one now for $50,000 and do another one for $50,000 later in the year. This way, if the market does continue to go lower, you are doing another conversion at those lower values. But if the market does rebound, you're getting some of it at today's depressed values, almost like Roth conversion cost averaging, if you will.
Right. So if you have a very large balance, would doing a series of conversions over a series of years make sense as well, potentially?
Generally speaking, that's the case. When you're looking at deciding how much to convert or when to convert, et cetera, the heart of good tax planning is pay tax when your rate is the lowest. And unfortunately, that is a lot simpler said than done for a variety of reasons. One is, income can fluctuate, deductions can fluctuate, and, more for some individuals than others. For instance, a retiree living on a pension and Social Security and taking the standard deduction, I can pretty much ballpark your taxable income at the beginning of the year to within a few dollars, right? But if you're a business owner and you're going through this situation, your income may be dramatically different than other years. Similarly, we talk about tax rates, and some people say, well, what if Congress changes the rates? That's another possibility too. And then, of course, there's just other aspects. For instance, you may be a joint filer today. And, let's just say that there's a married couple, a husband and wife, and the husband is 3 years older than the wife. Actuarially speaking, she's probably going to outlive him by about 7 years, 8 years maybe. And that's 7 or 8 years that she would go from using the joint brackets down to the single brackets, which up until about $400,000 of income are literally half the size for single filers as they are for joint filers. And many times the surviving spouse has all the same income, just not the lower Social Security check. And that's it. So when you say pay tax at your lowest rate, there's a lot that goes in there. Now, having said that, if you believe this is a low rate environment, and if asset values are depressed, there is no better time to convert than today. And it doesn't have to be an all or nothing decision. As you mentioned, it's probably better to do some over a number of years. If I had a $2 million IRA balance and I converted it all today, an overwhelming majority of that distribution is going to be taxed at the highest rate. If I were to instead take a 10-year time frame and do $225 or $250,000 a year, I might be able to get more of that money out at lower brackets as well.
Okay, so get some tax help here. It sounds like it also, I think, is important to mention that you don't want to be rating the IRA for the tax bill, right? You'd want to have those funds external to the account to pay any taxes due on the conversion.
So ideally, absolutely. That is, I would say, if you've got other, because it increases the cost of that conversion, right? You're now taking more money out of your IRA, pushing you into a higher bracket, et cetera. Now, there are some individuals who I've run across over the years who've just been incredibly successful savers, but they've done all of that savings inside their 401k or IRA. And in those limited exceptions, it sometimes can pay you may still be better off doing some conversions and paying the tax out of the IRA, simply because when you get to retirement, you're going to have to do the same thing anyway, right? Like once you get to RMD age and you're taking it out, you're still going to have to, because there's just no other place for you to pay the tax. You have no other money. So in those limited situations, sometimes I would say the answer is yes. But generally speaking, we do want to use outside assets simply because it allows us to convert more, because less of your income is being used up by income to pay the tax in the first place.
Got it. So turning over to people with taxable assets, let's think about them in this situation, strategies that they might use to take advantage of the fact that their tax bills might be at a low ebb in 2020.
Well, I would say certainly, anybody who has losses, tax loss harvesting is kind of like your bread and butter. But, while assets are depressed now from where they were, let's say, a year ago, or certainly at the start of the year, we've had a 10-year bull run, and a lot of people still have gains. They're just lower gains than they were before. For those individuals who may be in lower brackets, in particular, people in the 10 and 12% ordinary income tax bracket, which can be a lot of people. It's about $100,000 of income for a married couple. Once you back out that standard deduction, gets you back to the 12% bracket. So a lot of people still fall into that, especially in those years between, let's say, retirement and Social Security required minimum distributions, et cetera. So the ability to potentially sell gains that you have with long-term positions with long-term gain at a 0% capital gains rate is huge. For those who aren't aware, if you're in the 10 or 12% bracket, you can sell gain up to the maximum part of that bracket, the 12% ordinary income tax bracket, and they will be taxed at a 0% capital gains rate. And you might say, well, Jeff, why would I sell when the asset is so depressed? I don't want to do that. Okay, fine. Sell it and then buy it right back. You can sell it in the morning and buy it back in the afternoon, and that'll be fine. There's no wash sale rule. That's the number one question I always get. Like, well, Jeff, what about the wash sale rule? 30 days. And It doesn't apply because it only applies to losses. We're trying here to get a gain that's taxable at the 0% rate. Like, paying a 0% tax is actually better than not paying a tax at all because it increases your basis.
Okay. I want to look at one last scenario. With the CARES Act, people will not have to take required minimum distributions in 2020.
Sure.
Let's talk about people who find themselves in that situation where maybe their income, their tax bracket will be lower because no RMDs. Any strategies for them?
Sure. Again, looking at a low income year, let's accelerate income. If you don't have to take a required minimum distribution, maybe you substitute that distribution with a Roth conversion. Now, notably for individuals subject to required minimum distributions, they typically have to satisfy that required minimum distribution first, and then and only then can they convert on top of it. In other words, the RMD itself can't be converted. This year may be kind of a little bit of a golden opportunity in order to convert at lower income levels and replace what would be your normal distribution with a Roth conversion. And obviously, those who have already taken distributions earlier this year that perhaps they don't want anymore because they only took them thinking that they had a required minimum distribution, they can look to potentially put those dollars back into an IRA or other type of retirement account. If they're, let's say, within the 60-day window, that would be an easy way just to roll it back and keep your income low that way.
Well, Jeff, as always, you are a wealth of information. Thank you so much for taking time out of your schedule to be with us today.
It's always a pleasure. Thanks again for having me.
Thanks for watching. I'm Christine Benz for Morningstar.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you've enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.